Good day, everyone. This is Jackson Millan, the Wealth Mentor.
And Sam Panetta.
And we're here for another episode of Ask Aureus Anything. We're going to be bringing the fire for episode 37.
What does that mean?
We need special effects. So thanks for joining us. We're here to chat about things that have come up in the news in finance, business, strategy, anything that's going to affect you on your wealth journey, or anything that may interest you in the current world. This is an opportunity for you to contribute to the conversation, learn some new stuff, ask us some questions, get some value, and have a bit of fun on a Wednesday night.
Absolutely. And for anyone who hasn't seen an episode of Ask Aureus Anything before, we banter about all the current events, as Jackson said, but we do a live Q&A. So if anyone such as Shane Black has any questions for us while we're here live, throw them at us, and we're going to answer those live for you, so you get a little bit of value out of it and you get all your queries answered.
And if we don't have the answers, then Shane Black does. So he's here as backup just in case.
Hello, Marcel.
Marcel, thanks for joining us. Now, if you aren't part of the community yet, we have a community, the Wealth Mentor community has over 1,100 members. We contribute regular value, insights, and other things that are going to help you on your wealth journey. Most recent thing that we've been able to do is to provide our community members with a free will, which is generated by an estate planning specialist. So just one of the many value adds of joining the community. So make sure you search and make use of what we can provide. Now, Shane Black, we're glad you're here, and if we fall into any hot water, we hope that you're able to save us.
Rescue us from the abyss, Shane.
All right, so before we dive in, general advice warning, everything we talk about is general in nature. So before you run out and implement anything we discussed this evening, make sure you do get professional advice.
Absolutely.
So let's dive right in.
So the first article that has come across our universe today, Daniel's given us some love signs. We love you too, Daniel.
Love you, Daniel.
So the first article that's come across our desk this week that people wanted to talk about is that online property conveyancer PEXA readies for a $2 billion flow. So there's a lot of stuff in that headline, isn't there?
I knew you'd love this, Sam.
So to give you guys an idea, when a property settles, it's a bit of a legal process. So there's different parties from everyone who's related in the transaction, and they've been doing it paper-based for years, for a very long time.
Not just paper-based. People had to actually physically meet in a room.
Have you ever been to one of those settlement rooms?
It's a festival.
These lawyers, they just scream at each other until the property settles.
It's like a bullfight. It's crazy.
Lucky the clients aren't there, they'd be stressed. But PEXA is an online way of doing this. It's coming into the 21st century, and they've been growing steadily for years, and it looks like now they're ready to float, which means list on the Australian Stock Exchange and take the business public, and probably pocket a little bit of cash in the meantime.
Well, it's a phenomenal idea, Sam, because this is an industry that hasn't been revolutionized or disrupted for a long time.
Absolutely.
Which is one of those things that was just the way of doing things. There was a physical title, and there was physical loan documents. There was things that needed to be physically exchanged, and it just was for a very, very long time. That was just the way things were done. And this is a great solution to an age-old problem.
Yeah, and look, most banks are still doing everything physically. I think Macquarie Bank is sort of at the front of this. So they're doing all loan documents now electronically. So you sign them on the computer via an email. So they're leading the charge. But even the mortgage still has to be printed off and physically wet signed and posted back to the bank because the system itself, the Australian system hasn't moved on from paper settlements.
So where do they put all that paper? Because think about it, like how many loans would CBA have? As an example,
they'd have to have millions.
So imagine all of the paperwork that they've just got sitting somewhere. It's crazy. It's very, very crazy. It's funny, we had a client recently that had paid off their property a very long time ago, but never got the deed back. And how much of a problem was it to try and find where that piece of paper was?
No one knew where it was.
No one knew where it was.
Disappeared into the
abyss.
abyss.
Literally just disappeared. It was a mess. So it just goes to show that these innovators are going to improve problems that are occurring in the industry and hopefully provide some meaningful solutions.
Absolutely.
Michael,
g'day.
Good to see you today as well, mate. Thanks for coming in. Hopefully you got some value from our catch-up. And Big Sal, there is a big room with loan docs just sitting in at the Rethink Mall branch, most likely.
Yeah, so there is. So a lot of the branches themselves hold loan documents and titles and things like that. So I imagine they're sitting in branches all across the country. Sure. But what about those other loans that I write? Exactly, you know what I mean? Right. They'd have to have a big room for the loans that I write. Surely
they've got their own room. It's called the Sam Panetta room. Phenomenal. So look, obviously this is probably not something that most of you have dealt with. But what do you think about there being innovation in the property space surrounding all of these other administrative parts of the process? I'd be interested to get your insights.
Yeah, well, what other industries do you guys think have been doing the same thing for so long, haven't been disrupted, and it's an archaic and old way of doing things? We saw the taxi industry gets smashed by Uber, the hotel industry gets smashed by Airbnb. So what other industries do you think that haven't come into the 21st century yet? We'd love to know your thoughts.
Yep, beautiful. All right, so next one here, capital rethink. Business leaders call for new finance options for small business. Now, we've spoken about this a couple of times, and as those of you may know who've been watching us for a while or who runs a small business, you probably realise that it's very, very difficult to get finance. The pitch typically goes, you go to the bank and there's a little business banker who's like, oh, yeah, I'll be able to get you the loan. And then after a little while, it goes to credit and then it gets knocked back. Computer says no, and then you're basically up the creek without a paddle. And I think this is really important. I think it's important that there are options out there for small business to be able to just grow and scale, and that you're not going to get someone who works in some branch, get your hopes up, and then just let you down time and time again.
Look, and this space is changing, and this is really important. So in Australia, it's relatively easy to get finance for residential property, right? That's why property markets are so popular, because it's easy to get money to buy residential real estate. But the banks in Australia are really risk averse when it comes to businesses and to small businesses in particular, when compared to like the likes of the United States.
Yeah, well, you see in movies, right? The blokes go into a big bank and they've got their business plan and they sit down in a little cubicle with a bloke and they present the business plan.
And someone writes them
a check and gives it to him.
That doesn't happen in Australia. Nah. In Australia, you go there with your business plan and they say, oh, that's fantastic, go away. And they send you on your merry way. And I think this is a real problem with small businesses that are actually trying to grow, to be able to get the finance and the capital they need to continue to grow. And I'm glad that this is changing, because as we've seen, the property markets have slowed down, and now what's going to be the biggest driver in the Australian economy? And I think it's going to be small and medium businesses. 100%. So we need funders who are willing to back these business owners who are backing themselves.
100%. I think this is going to come through technology, peer-to-peer lending, and essentially these technology-driven platforms, where people are essentially putting money into an intermediary for some type of fund. The fund is being in control of vetting the businesses, vetting their idea, working out the risks, and then lending the money out.
Absolutely.
What I'd be really interested to see if there's any other ways to do this. Like, there's obviously venture capitalists and angel investors that typically will take on I guess, big businesses that have opportunity for big scale. Typically, technology businesses are willing to take a stake in the business as a result of putting money in. But I wonder if there's some way that there can be a technology platform that allows that to happen.
I think they exist. I think they're just not mainstream enough, and people aren't using them enough. And the costs can be prohibitive too, I think, 100%. In some cases.
Oh, yeah, it can be very expensive. Look, I think as it continues to grow, there's more, competition in the space. Hopefully it becomes more competitive, because you see some of these technology-driven lending platforms, and some of the interest rates are ludicrous, like 2% a month.
Yeah, which is outrageous. 24%. You might as well fund it on a credit card.
100%.
And it's look, it's one of these things where when Jackson and I launched Aureus, we put some capital into business, and we had an investor provide some funding, and we also got some bank funding as well, because we've been acquiring other businesses as we're growing. But I think the only reason the banks lent us the money, nothing to do with the business itself. I think it's because we owned real estate.
Correct. That's the only reason. And that's all they want. So they want security, and they're only going to lend you up to 50%. So they can basically never lose. If your business goes well, fantastic. Or if you go broke, they take your property. So it's kind of a win-win for the bank, which obviously that's their value proposition. That's what they do.
Yeah.
But I think they could be doing more for small business. So it's great that this thing is happening. And it's basically talking about how there's a huge and tremendous growth year on year in terms of small businesses. So imagine if there were other funding options to, I guess, further amplify that. That'd be phenomenal.
Well, the world's changing. Years ago, if you wanted a job, you had to go and work in a factory that a landlord owned, with farmers and things like that. But today, there's so much opportunity that the small businesses are popping up because you can essentially enter markets and participate and do very well out of it without having massive amounts of capital like was needed, a couple generations ago and the generations before that. So 100%. I think the lending environment needs to keep up with those
exactly
changes.
Right. So we've got a few comments here. Lena Panetta, thanks for joining
us.
Hello,
Nonna. Hello.
Peter Akuri giving me some flack. Jackson Buddy, which lumberjack man did you mug for that jumper? Now that's what I call a bad investment. Peter Akuri. Mate, I rolled some bloke down at the mall.
What are we going to do with you, Peter? What are we going to do?
Peter, I must say, you're here every single week. You must be so much smarter as a result of coming to our 37 Ask Aureus Anythings. Like, you're going to get a job here soon, mate. I promise.
Peter's our #1 most loyal fan.
Mate,
we love Pete.
He's got all the tools. He's going to be able to start another business.
He's going to start a competing business. Yeah. Instead of Aureus Financial, it's going to be Akuri Financial.
Akuri Financial. I love it. Phenomenal. Thanks for joining us, everyone.
Thanks, Carla. Carla's here. G'day, Carla.
So, question to you guys. If you run a small business, have you tried to apply for finance before? What's your experience been? And essentially, what would you like to see happen in terms of opening up options to allow you to fund your ideas, fund your ambitions without having to give the bank everything in return? I'd love to hear your thoughts.
All right, good stuff. So, I like this one. So the next article reads, CBA targets first-time property buyers with a 50 basis point discount on new loans. Great article. 50 basis point discount is not actually that good. We can get discounts triple the size of that, but I like what they're getting at. So what's happened over the recent years is that banks were bending over backwards to get residential investors into the property market. And they were giving very discounted rates for investors, very discounted rates for interest-only lending, and we saw that just drive the value of property up big time in Sydney and Melbourne over the past 5 or 6 years. And that's starting to slow. New rules were coming out by the powers that be, and investor lending is shrinking as a proportion of the market. Dramatic shrinking over the past 12 months. And what that has allowed is the opportunity for home buyers to upgrade their home and come back into the market, and people that are refinancing for a better deal. But the first home buyers, when we're combining the way the banks are treating first home buyers with the way that the government treats first home buyers, this is the best time I've ever seen in my time in the industry for first home buyers to enter the market, because they're getting really, really sharp interest rates. They can do it on very, very small deposits. And they have family guarantees and all these other little bits and bobs. And then a lot of them, if your purchase price is lower than $650, you're not even paying any stamp duty, and that phases out up to $800, $850. But all of this combining is letting all these young people that were locked out of the property market for years now get their chance and get their shot at getting onto the property ladder. And I remember when I bought my first property, it was the happiest day ever. So I'm excited for all these first-time buyers that now have the opportunity to get into the market. So that's a feel-good story, that one.
That's great. I think, but it is important that, and I think the banks are doing this for a reason, right? There's an influx of investors entering the market. We know that investors are always linked to ROI, return on investment. So they are very sensitive to economic and macroeconomic risks and pressures. So therefore, when we're in a market where it's primarily owner-occupiers, the last thing that you're going to sell is your own home. And you're going to be more, I guess, aware to, I guess, the things that are happening aren't going to affect you as much, because you're always going to come back to, I need to have my own home. The last thing I want to do is go back to renting. However, when we look at this scenario, this is about adding more people who are hopefully owner-occupiers to the market, first-time property buyers, hopefully living in it themselves. But we've got to be mindful that when you are getting into your first property, with all of these other incentives that the bank is offering, that you're actually able to afford it if rates continue to go up, particularly if you are taking on a higher loan-to-value ratio on that property. So as Sam said, you can get in with a lower deposit, but that means you're going to have a higher loan as a result. So make sure you do your numbers. If you are looking to get into the property market, do your cash flows, understand what it's going to cost you as soon as you get in with all of the discounts and other things, but also try and price in additional interest rate increases to ensure that you not only have the ability to maintain your lifestyle, but you've still got a good surplus to hopefully try and pay off that loan as quickly as you possibly can as well. So these are all important considerations.
Yeah, and I think for a lot of the young people, they're going in with small deposits, so they're saving their deposits as they've been renting, and then the money that they were paying to rent, they're going to be paying to the mortgage.
100%.
So a lot of them are really good income earners, above average income earners, taking on a lot of debt, and sometimes using family guarantees, sometimes using small deposits. And one of the things in the conversations I always have with my first-time home buyers is to make sure that they're checking out their super and they're checking out their insurance, because the ability of them to meet their repayments on the home loan is based entirely on their ability to earn an income.
Yeah.
So if anything were to happen and they didn't have protection against that, they're going to be in big trouble. And look, I wasn't much of an advocate for it in the past. 7 foot tall and bulletproof and all of that. But after I got sick and I couldn't work for 3 months nearly, I realized the importance of having some sort of protection
100%.
in place.
Yeah, very important. So for those of you who are watching, is this a kind of breath of fresh air? Did you feel like you'd missed the property ladder, the boat? And is this going to give you a new opportunity to potentially get your foot on the ladder? Are you working on it? Share us your views. What do you think about property overall? And is this going to help you get your first home sooner?
So for you guys who have bought your first home, how did you do it? Let us know. If you want to buy your first home, what's stopping you? Write in the comments and see what sort of value we can add.
Love that.
Hello, Nonno.
Peter Panetta, good to have you here, mate.
Thanks for joining.
All right, so we've obviously we've put CBA in a positive light, and now we're going to cast shadows on them again. This is something that I'm very passionate about, this particular issue. Now, ASIC launches review into school banking, particularly the Dolomites program. This is something that Scott Pape, Barefoot Investor, spoke about in his book. I've spoken about in mine. I believe that the Dolomites program is essentially a bit of a scam. It is preying on the young to be able to put and implant marketing initiatives into their mind, to be able to start a conversation with them as soon as they are of age, to be able to sell them debt. Simple as that. And when we looked at the return on investment for all of these things, the Dolomites program, I remember personally, I'd put Dolomites in for years, and then by the end of it, it was basically nothing. After all the fees and everything were taken out, it was basically nothing. So ASIC have finally launched an inquiry into it with outcry of people wanting to have it banned and having out ruled. I think that's important. They've determined the value of the Dolomites program to be estimated about $10 billion. And that's a huge asset for a big bank like CBA.
Absolutely.
Like, how many kids have gone through the Dolomites program and as a result become banking customers with CBA?
I still bank with CBA.
Have you always banked with CBA?
Never had another bank for my personal stuff. I've had other banks for other purposes, but my day-to-day is still done with CBA.
See, my first bank was St. George. So although I had a Dolomites account, I remember one of my sister's very close friends worked with St. George, and she worked in marketing. So she gave me heaps of like St. George, like marketing stuff, like the Little Dragon and all that kind of stuff. So, and my mum banked with St. George. So I started banking with St. George, but I'm now with CBA.
Yeah.
Look, the banking experience is great. I think CBA is a great bank. However, I think that the predatory way in which they use the Dolomites program as a marketing tool is frowned upon. You shouldn't do it. So it's one of those things. But let us know your thoughts. What do you think about the Dolomites program? Did you use it as a kid? Is it how much have at the end of the process when you got to 18? I'd be interested to find out.
When I was at school, my mum used to give me pocket money to buy like lunch at the canteen. Yeah, I didn't buy any lunch, mate. I put the money in my pocket. I went home. By the end of primary school, I got a couple $1,000 saved up. That's phenomenal. That's Dolomites for you. That's SJ's bed mattress. That's the bank. That was my bank account.
I'll tell you, I could tell things about what I did at primary school, but I don't want to incriminate myself.
All right. Well, let's Let's talk about something else.
We'll talk about something else.
Joe Panetta. I bought my first home thanks to my #1 broker.
Joe?
That's me. I'm the #1 broker he's talking about, Joe. I'm very proud of you, mate, and I'm glad to help get you guys into your first home, and the first of many, I'm certain.
Fingers crossed, we'll get you there, mate. All right. Now, Daniel, Big Daniel Pastro, he's got a question. So, if property prices slide a bit, do unit prices slide more? Thinking is that if there is strong demand for first home buyers, houses will hold up better than as first home buyers may be able to afford a house now, whereas before they might only have been able to afford a unit. This is an interesting point.
I've got the perfect answer to this one.
Give me the answer.
I've got the perfect answer to this one. So typically, it depends on the area. So in an area, let's say the Northern Beaches, where demand is still pretty strong and there's not a lot of supply, we find that the units and the houses sort of come off on the same percentage base. So a $1.5 million house, if it comes off 10%, might come off 150 grand, and a $600,000 unit might come off 60 grand. So percentage bases are pretty similar, but because the houses are worth more, the
dollar value is bigger.
The dollar value is bigger on the drop. However, where this doesn't apply is in places like Brisbane, where we're seeing an oversupply of units. Because of the oversupply of units, the houses are still going up, but because of local demographics and local economics, but the prices of units are coming off because it's that one particular style of stock that's being produced at a rate higher than what people actually need.
Makes sense.
So in some places, yes, units are coming off more than houses. In other places, houses are coming off more than units.
Yeah, I think ultimately property is driven by supply and demand. Now, I think on the point of what we're talking about in terms of first home buyers, particularly if we're talking first home buyers in Sydney, it is very unlikely that a first home buyer, if they want to qualify for the incentives, is going to be buying a house. They're going to be priced out.
Absolutely.
So that's, I guess, further reason for why the unit market may be supported in terms of the likelihood of it dropping. Now, however, historically, we've seen that because there is more supply in the unit market, so what will typically happen is a developer will buy land when the market had sat flat for a while. So typically the very beginning of the cycle, it's where they can get it the cheapest because the market's probably been sitting flat for 5 or 7 years. They then go for DAs. They then go for their pre-sales. They then develop the property, and hopefully by the end of the cycle, when the market's at its peak, they can sell it for its highest price. Then all of the supply hits the market gets flooded, and then the cycle rinses and repeats. Because there is a higher supply of units, because they can build more, it's essentially what a unit is, that there is more fluctuations in the unit market over a full cycle. So I think it's important to understand that, supply and demand is a big consideration. But I think that with all of these incentives, with people getting into the property market with lesser deposit, I think more often than not, there's going to be people that are, of course, going to be buying houses. But from our perspective, we're seeing more clients buy units.
Majority are buying units, especially in a developed area like the Northern Beaches and most of Sydney. Most first home buyers are buying units. What we're seeing at the moment, we're seeing a lot of, is we're seeing, because units haven't dropped as much as houses, we're seeing people who own units sell their units, get a pre-approval, buy a house, because the price gap's so much different. So maybe they lost 100 grand on their unit, but the house that they want to buy, maybe it's dropped by 200 or 300 grand. So they're using that as an opportunity to upgrade into the home market from the unit market. And that's something that I'm probably doing a couple of those a week for at the moment. So it's a real phenomenon that's playing out.
Beautiful. All right, let's move on to the next one.
All right, so Telstra considers executive pay overhaul after investors' first strike against board. That's
big news.
You like this, eh?
I love this stuff.
You like this sort of stuff. Before we get stuck into it, let's answer this question for Rando.
Thanks for jumping on, mate. Good to chat with you today. So, hi, gents. For first home buyers, how many months of pay slips and bank statements do lenders now ask for?
Excellent question, mate. So every lender is different. So if the very bare minimum will be 1 pay slip and probably 3 months bank statements. But as you complicate your income. So if there's bonuses or commissions or overtime or penalty rates or any of these sorts of things, then they're going to continue to ask for more paperwork. But the absolute minimum is one pay slip and 3-month bank statements.
And they're starting to pay more attention to what is in those bank statements now, aren't they?
Absolutely, yeah. So before, you used to have for living costs, you'd ask the client, what is your estimated monthly living cost? They'd give you a round figure. They'd say $2,000 or $2,500 or $1,500. These days, we do an itemized expenses for each client. We enter that into the loan application, and when they're looking at that bank transaction history, if it doesn't line up, they're going to query it. They're going to say, well, what's this expense or what's that expense? And this is the first time probably over the past 12 months they've ever done this. And that's just the new normal now. They're really scrutinising people's living expenses.
Which is good. And I think it's important that people know this, because I think with all this fear mongering that's going on in the property space right now, of this impending collapse of the property market, the banks are doing their best to ensure that doesn't happen. And all of these questions, although it may be annoying as somebody who's trying to borrow money, it's extending the time that the process takes. It's potentially reducing your borrowing capacity, or definitely is. It is for a good reason. And it's because the banks want to be responsible, want to ensure that people are protected. So property continues to do what it always has.
Absolutely.
Beautiful. Great question, mate. Fantastic.
Thanks, Rando.
All right. So Telstra.
So let's recap.
Let's recap.
So the headline on this article was Telstra considers executive pay overhaul after investors' first strike against board. This is Australian tall poppy syndrome. They don't like it when people get too big for their boots and they chop them down. And the CEOs and the executives of Australia's largest listed companies are the easiest target.
But I think it is warranted, right?
Absolutely.
I think that I've spoken about this a number of times. Executive remuneration is warranted as long as they're driving performance, they're delivering value to shareholders, because that's what they're employed to do. Now, if shareholders are wearing the brunt of whether it be a macro external environment or internal decisions, then the executives should be penalised also. Although it's not a linear and they're directly correlated, just because the business is doing poorly in the share market doesn't necessarily mean that the executives aren't doing their job. But I think it's important to consider that if there is long-term underperformance, the company is suffering, that it's economics 101, where you cannot turn a profit, you need to minimise your losses. And I think that it's just got to a breaking point where the shareholders have raised their first strike against the board. That gets to a point of mediation where the board then does a review, and essentially if it continues to go on, there can be a second strike and the board can actually be forced to spill positions and then reseat, which is not necessarily a bad thing. I think if a business has been suffering and the same old tricks aren't working, then they should be looking for potentially fresh blood.
I think so, mate. I think there's two massive sides to this, right? So we've seen, you've seen some of these like mining companies that have listed, these speculative companies, they go public, they've never made $1 in their life. The CEO pays himself $5 million a year, and then in a couple of years, the company dissolves and goes belly up. Yeah. All the investors lose everything, but old CEO mates is now living the dream somewhere. Yeah. And then on the other side, we see like the story Domino's and Don Meij, the CEO of Domino's. It's essentially been the best performer over the past 6 or 7 years in the stock market, both in the share price and as a business itself. And I think he crushed it. And I think he got 20 mil or 25 mil in share options that came. So he had a very good payday in 1 year off the back of that. But he has created hundreds of millions, if not billions of dollars of value in the business, being its leader. So if you can create $1 billion in value in a business and you get paid $25 million to do so, I think that's warranted. I think
that's fair, 100%. Because when you look at it as a percentage of profits, it's well justified.
Yeah.
And essentially, although it seems huge, and although that most of us are never going to get to that point where we can even fathom earning that amount of income, in that position, it's not easy. And if you're manufacturing that much value, then you should be rewarded for it. But it goes both ways. I don't think that you should be able to sit in a position where you're not delivering value and you are deriving benefit from it. We've seen some situations where when you look at executive pay and way that their executive remuneration is structured, it is only for their own benefit.
Yes.
We've seen where there's been chairmen and CEOs who've been on fixed remuneration or consulting fees with no KPIs. No key performance indicators to validate their worth. They just sit there fat and happy, earning their income whilst the business potentially burns to the ground. And this is not a good way to do things. You should align the objectives of the shareholders with the objectives and expectations of your executive team, whether you're in a small business or whether you're in a big business. This is just good business 101.
Absolutely.
Yeah. What do you guys think? Is this stuff that floats your boat? Do you get excited about executive remuneration? Michael Shaw would love a bit of executive remuneration. Michael and I actually did our MBA together. We've been long-term friends. And funnily enough, I run into Michael in an exam hall while we're both doing our MBA. So I'm sure Michael would love a bit of banter about executive remuneration.
I've never ran into anyone at an exam hall.
What do you think? You never?
Nah,
No?
I've never been. What's it look like? I've never been to one.
I love that. So good. All right. Fantastic. So let's get into some questions. We've got some questions here.
We did get some questions during the week.
Those of you who are here, if you've got questions, post them up. We're here to add value. So if there's anything that's top of mind, want to talk about some of the subjects that we've already spoken about, anything else that's of interest, anything that's top of mind, let us know.
Look, we get heaps of questions all week. We try to note down, 4 or 5 that are really good and we think that other people might get value out of that we've heard over the past week. So if you guys do have anything live, ask the question and we'll answer it. But we're about to get stuck into those. Before we do, Michael Shaw says, great time to join, hilarious.
Glad you enjoy our cool wit and charm. So we're here to brighten.
We can't be too serious, Michael. When you're talking numbers all day, you've got to have a bit of a laugh.
Right. Gary, I'll give you 50 cents and or a chicken wing for some stock options. Mate, I think Aureus stock is worth a little bit more than that. Give us some credit, mate. We've been working hard
on, Gazza.
For the past 12
Blood,
months.
sweat and tears.
All right. So the first question we had here was, what does it cost to get good advice? Which is a great question. And we often find that a lot of clients who do make an inquiry to come and speak to us, this is sometimes their first question. And look, it can be difficult to answer, but let's set some expectations. Let's flip this on its head. What is the value of the advice that you're getting is probably the first thing. And typically when we're looking at value for anything, there is the quantitative value. What is the physical monetary return on investment? And what is the qualitative value? I guess the outcomes, the soft side of things that's associated with working with an advisor, a business coach, an accountant, mortgage broker, whatever that may be. Now, once again, a good advisor will tailor a pricing strategy to ensure that as a result of working with them, they actually put you in a net better position, typically substantially better net position as a result of that working relationship. To give you some expectations, there's typically broken into 2 components. Now, we are a flat fee-for-service business. We don't charge percentage of assets under management. We don't have complicated pricing structures. It is based on your situation, what you're working towards, the complexity of your advice that is required, the amount of work that is involved, and the outcomes we can achieve for you. We call this a value-based model. Now, to set some expectations, it's broken into 2 components. An upfront advice fee, which is basically preparing the strategy, creating it, doing all the due diligence, educating you through the process, helping you put it all into place, making sure it works for you. And then there is an ongoing coaching, on-track management, which is typically a month to month, depending on the scope of the engagement, how often you want to meet with us, what we need to do, and also where we can continue to add value. Now, for most clients, it typically starts at about $1,000 to $1,500 for very, very simple stuff. But in some cases can go anywhere upwards of $15,000 or $20,000 as an upfront fee for business clients who have complex strategic advice. Once again, the value associated with that is substantially higher, and we link that back. In terms of the ongoing side of things, it can start at about $150 a month, and it can go anywhere up to a couple $1,000 a month for complex business clients. So once again, don't let price impede your ability to talk about and look into getting advice. Once again, a good advisor should be able to articulate that value. And the thing that we offer is that, and I haven't seen any other advice businesses do this, is we give all of our clients a money back guarantee. That's us putting our money where our mouth is. If I take a client on, I provide them with some expectations of what I can do for them. And as a result of our working relationship, we can't put them in a better position or can't deliver on our promise. We're giving their money back. So it's essentially creating that asymmetrical risk versus return. It makes it a no-brainer. So that's what we do.
I can't add to that, mate. That's perfect. You perfectly summed that up.
In a nutshell. So once again, just as a result of even the conversations, you're going to get more value out of it, even if you choose to go about it for yourself. It's one of those things. You can't, honestly, I can't pay enough for good advice. How much would we would spend a lot of money every single year on our professional and personal development?
Too much money.
Too much money. Sam always asks the question. I go, Sam, you've got to persevere. You've got to spend on these things. I've spent hundreds of thousands of dollars on my personal and professional development. So it's something that you can't spend enough on.
Look, it's one of these things that for most people with anything in life, not just with finance, you're better off getting the experts involved. You know what I mean? How many times has someone, built a house and made a mess of it because
100%.
they haven't got experts involved, or I don't know what sort of things like cooking food. I go to cafes and restaurants to cook food because I'll mess it up. But it's one of these things that if it's the value that's important. Do you know what I mean? And I think that's what you articulate very well, and what we do here very well is that we show the value and then link the price up to the value. And I think that's a very good way of doing things.
Exactly right. Cool. All right.
So this is a question I get all the time. What sort of savings can you get from refinancing your home loan? So most people know that if you refinance your home loan, you're going to get a better deal. Most people just put it on the back burner and they don't do it. So what sort of savings can you get from refinancing your home loan? Well, I'm doing one at the moment where I'm saving the clients $21,000 a year in interest. $21,000 a year. You need to ask yourself, how many days do you need to work? Or how many weeks or months do you need to work to bank $21,000 or save $21,000?
A lot of money.
All right, that is a lot of money, and that's a really good example. But for most clients, we can save anywhere between 3 to 6 or 3 to 8 grand a year in interest. That's just your standard, typical client, and that's pretty good. You know what I mean? How long or how much would it take you to go to work, earn that money, pay tax on it, and then save it in the bank account? Much easier just to refinance your home loan. So it's you don't know until you go out there and ask the question.
100%. And just something, it doesn't cost you anything to give it a shot.
It doesn't even cost you anything to do. Do you know what I mean? It's you might have to pay a little bit of bank fees to get the thing done, but a lot of the time now we can negotiate rebates with the new bank. They actually cover the costs of your refinance, and then they give you a little bit of money on top. So it's really competitive out there, and the consumer's the winner. And if you've got, start putting personal loans and credit cards into the mix that you can consolidate into your home loan, we start talking about thousands of dollars a month in better cash flow, and potentially tens of thousands of dollars a year in savings. So it's just one of these things that it's so easy to ignore, but it's not a lot of work to do it, get it right, and just make or save a lot of money.
Love that. So for those of you who have a home loan or an investment loan, when was the last time that you reviewed it? And if you have reviewed it, what were some of the savings that you've had through the process? We'd appreciate you sharing.
Absolutely.
All right, so next question we had was, what was the difference between good debts and bad debts? Great question. Something that I talk about a lot in my book. And ultimately, the difference between a good debt and a bad debt is that a bad debt is a debt that is linked towards a depreciating asset or something that doesn't provide you with an income. And you have to pay for an after-tax dollars, meaning that the interest and costs associated with that debt are not tax deductible to you. Some of the examples of that would be credit card, personal loan, car loan, and even your home on your principal place of residence. Although your home and loan is used to buy a good asset, it is a bad debt because you're paying for it in after-tax dollars. So you have to earn money, pay tax to then pay the bank their interest rate. A good debt is anything that is used against appreciating assets, which provides you with an income, and the loan is then tax deductible to you. meaning that you essentially have the ability of the tax system to provide you with the ability to allow you to make more money work for you. So this is for anything that is used for property, shares, or even business, assuming that you have not used that loan to supplement your cash flow. If you're running a business at a loss and you're using that debt as a way of bridging the gap, then I wouldn't treat that as a good debt. So that's what it is in a nutshell.
It's a controversial opinion that the debt on your house or your home is a bad debt, and I think it's warranted talking a little bit more
100%.
about, because the home itself, it's a good asset, all right, and you still are better off having the bad debt on your good home in lieu of paying rent. But when you do nail it down, you do knuckle down. What you want to do, you do want to smash that home loan as soon as possible, and then look to invest or even borrow to invest in other assets. So you're reducing that bad debt and you're increasing your good debt, because even though investment lending is more expensive than occupied lending, once you factor in the tax, man, it's considerably cheaper. So it's I just thought we'd delve into that a little bit more.
Yeah, and when it comes to tackling your debts, you need to create a strategy. I talk about this in my book. You've got to look at what the cost is in after-tax dollars. You need to gross up the amount of repayments. Now, you typically work from all of your bad debts, and then you work from the ones that have the highest interest all the way down to the ones that have the lowest interest. However, you start tackling the smallest bad debts first. So typically you find that, let's say, for example, as a credit card with $1,000. The minimum repayments, if you get rid of that, frees up additional cash flow that will allow you to continue to snowball your other debts. So it's about building a bit of a strategy, working out a bit of an action plan, and this is something that we've helped a lot of our clients with, who are in a bit of trouble, have started a business, had tough times with cash flow, have had one of the family go on maternity leave when they've started a family, so they're on a single income. All of these things can sometimes result in us taking on bad debts. So then it's a matter of how do we formulate a plan to get out of them, and then get good debts to make money work for us. So that's an important strategy.
Yeah, and you definitely need a plan around that. I was having a conversation today. The person I was talking to was saying that she had some friends who had accumulated bad debts when they were teenagers. They're in their 30s now. They're still paying them off. That's going to slow you down the rest of your life to stop you from getting ahead. So you really do need a plan to get 100%. Out of those bad debts.
G'day, Belma. Thanks for joining us.
Hello.
All right. So over to you, mate.
All right, so this is a question I got today. Is there any point trying to refinance my home loan if I only secured it last year? In some cases, yes. In some cases, no. So if you used an expensive home loan for whatever reason to buy the particular property, it is worth refinancing away from that expensive home loan to a more competitive mainstream home loan. That's a lot of the case where you'll see someone refinance in sort of the first 12 months or at 12 months. And on the other flip side, if you had a good broker do the home loan in the first place, in the first 12 months, it should still be pretty competitive. So what happens, we find that over time, banks just tend to lift the interest rates on home loans. So the longer you leave it, the worse the rate gets. But normally in the first 12 months, they're not normally too bad, unless you've been pitched somewhere and you've been taken somewhere that's giving you a shocking rate. So look, when someone comes to me after 12 months and they want to look at their home loan, I always look at it, delve into it. Half the time, yes, it's worth doing because for some reason. The other half of the time, it's worth just me ringing up their existing bank and saying, hey, can we get a bit of a discount for these guys and get their lending down or the interest rate down a little bit. So it's still worthwhile looking at, but it's more of a 50-50 whether you'd actually go and complete a refinance.
Yeah, I'd say just chuck a note in your diary every 12 months, just review it, kick the tires on it. And yeah, it's always worthwhile making sure that it's competitive.
Or if you're a client of Aureus, we do it every 12 months for you. So you don't have to think about it.
All right. So next one is it worthwhile to consult a property buyer when looking for a home or an investment? We've spoken about this a couple of times and we're very firm on this subject that yes, you should. Particularly if you are a first-time property buyer or investor, or if you're looking to buy a property interstate, anywhere that is outside of your backyard. And the reason for this is because there are so many factors that go into understanding the intrinsic value of a property and making an objective decision that is going to be buying an asset in which is going to stand the highest likelihood of increasing in value above or beyond the average, comes down to experience and education. Now, a good quality property buyer has a methodology in which they use when it comes to researching, analysing and selecting property. They apply that objectively to ensure that they make sure that all the criteria are met and ensure that the property is investment grade and provides opportunities for future growth based on both the micro understanding of the property itself compared to the local area, aspect, size, layout, where is it? Is it close to arterial roads or sub-arterial roads? Is it in a flood zone? Is it all of these other things that sometimes as a punter you can overlook? And also looking at the macro environment. Is there affluent people in the area? Is it growing? What's the developments that are coming online? What's the supply? All of these other things that go into selecting a property that is going to have the best opportunity for future performance. Now, when you look at it, most property buyers charge around 2% of the value of the property. So when you think about it, 2% seems like a big number when you're talking about an asset, 500, 750,000, $1 million. However, when you look at it in the grand scheme of things, if you do this right, there's opportunity that you can make that money back within a couple of months. And we've seen that with our clients that we've referred to, our property partners that we work with, PMC. If you're interested, we've got a podcast with PMC. We've spoken about it a lot. And it just gives you an insight around what they actually do behind the scenes. So I think the average person, I know when I first started looking at it, I'm like, nah, stuff that. Like, it's too expensive. It was all about cost. It's similar to what people do sometimes with us.
Yeah, absolutely.
But once you actually understand what goes into it behind the scenes, the amount of work that's involved in the process, you start to appreciate the value. So I'd say at least look into it and before you kind of dive in feet first.
I'll never buy another property without a buyer's agent. I'll use the team at PMC. Not even my home. When I buy my home, probably next year, I'll be getting them to do it, take the emotion out of it for the negotiating and all of that. What's the chance that if you're buying $1 million property, they can't negotiate at 20 grand better than you and save you their entire fee up front?
Exactly right.
Yeah, I think it's important to note a lot of these property guys, they fall into three categories. There's ones that are very, very good and they're worth their weight in gold. There's ones that are really, really shit and they don't even know it. And there's others that are sharks and they're waiting to eat you and they'll sell you the crappiest property somewhere because that's their stock. You have to educate yourself and understand who is what character in the property space because you do not want to get a $500,000 investment wrong.
And there's a process whenever you interview any professional. I've included as part of my book, Choosing the Right Guide. And there is essentially a series of questions that you can print off, sit down with these individuals and grill them for as long as you like to ensure that they're actually going to act in your best interest. And by following that process methodically, interviewing the right people, asking the right questions, you can ensure that you make the best possible decision that you can. So I've got those tools in my book if you would like to access that. So that's the end of Ask Aureus Anything this week.
We're done. We're talking fast. We've got it through 10 minutes early.
We've got it crushed. So those of you who are watching this, when we do go offline, feel free to continue to post your comments, any of your feedback, your 2 cents, and we want you to engage in the conversation. In any case, we'll get back to it shortly. Actually, we've got a comment here. Michael Farmer, we used a buyer's agent. It was the best decision we made. Always seek the professional.
Love it. You nailed it, Mick. You've absolutely nailed it.
Exactly right. It's one of those things that you just got to get the right advice from the right people, and it makes the journey a whole lot easier. So thanks everyone for their contributions. We look forward to catching up again same time next week.
Thank you very much, guys.
Catch you later.